There are key things that I look for whenever I want to analyze the charts. The first is to identify the key levels, identify the market structure, and identify the liquidity. I'm going to show you how to do all of these in this video. But before going into that, if you're seeing me for the first time, my name is Divine, and what I basically do on this channel is document how I trade and as well show you the mindset behind my strategy. If you want to see content like this, I want you to smash the subscribe button and like this video. I'll be right back. Now, for us to be able to identify the key levels, identify market structure, and identify liquidities, there are steps or approach you need to follow and identify these things clearly on the chart. The reason I'm on the board here is to give you a sketch of what it looks like, so that when you go to the chart, it's going to be easy. First, you need to be able to understand the skeleton before you add the bodies to it. So what I'm going to give you is like a sketch or a skeleton to what you want to see on the chart. Now, for us to be able to identify key levels, we want to first of all understand the time frame at which we want to identify the key level, because on every time frame there's a key level, and you want to always understand the reason why you're using a particular key level at a particular time frame. But my first approach simply first of all is to understand the high time frame key levels, because the high time frame key levels controls the other key levels in the market. And for us to be able to understand this key level, we want to simply understand how to draw support and a resistance. First thing first off, whenever you come to the charts, price is either going to the upside, either going to the downside, or is that resting. What this means is whenever you open the chart, price is either going like this to the upside, or it's going like this to the downside, or price is basically resting, equal highs and equal low. Now, whenever you open the daily time frame, you want to simply understand how price is moving. If price is going to the upside, going to the downside, or price is basically resting. Now, having understood if price is going to the upside, downside, or resting, the next thing you want to do is to identify the key levels, and I'm going to show you how to identify the key levels in this video. Now, for us to identify the key level, we want to simply use our support and resistance to identify the resistance, and we want to use our trend line to identify support. So basically, this is support, and this is the resistance. That's the first thing you want to do. If you understand where the support and resistance is and be able to interpret support and resistance, then you have done the first part. Now, for us to identify this key level, what you want to basically do is to understand the points where price reacted from on the support and on the resistance. That means this point here is our resistance key level, and here is our support key level. That's how to identify the support and resistance key level. Now, let's for instance say, I don't want this video to be very long, so I'm going to make it very brief and short. Let's for instance say price was simply going to the upside, and probably these are resistance and this is support, and price break above the resistance. Now, how do we identify the key levels in this particular scenario here? First of all, here is support key level, here is resistance key level, and here is another key level. That means there's basically three key levels on the chart here. Here is a resistance key level, and this point where price breakout has become a support key level. So the key levels are simply this point here and this point. That is the key level. The same thing goes if price break below the support. Here becomes the key level, and the current point where price is become the resistance support key level. Do you understand? So basically, for us to be able to identify key levels, we want to simply look at that point where price made a reaction. For instance, price goes to this point here and made a reaction, and we were simply breaking out of the resistance. And once it broke out, it became a support key level. I hope I'm not confusing people. It became a support key level, right? So basically, one of the key ways to identify a key level is by simply understanding direction and being able to identify the resistance. Now, when it comes to market structure, there are key three things that contains in every market structure. That means for every market structure that you see, there's swing high and swing low. There's break of structure, and there is change of character. That means for you to be able to identify market structure correctly, we want to be able to identify these three things: swing high and swing low, break of market structure, and change of character. Now let's for instance say we identified a key level here, and we also identified another key level here on the time frame. And when we came to the 4 hours time frame, price was basically going to the upside from the key level, giving us swing high and swing low and swing high. Now for us to be able to identify this market structure, we want to be able to identify the swing high and swing low, the break of structure, and change of character. Now the swing high and swing low help us to understand how we can be able to identify the break of structure and change of character. The most important thing in this whole market structure is to identify the highs and low. In this case scenario, we are seeing the low here, we are seeing the high here, we are seeing the low, the high, the low, the high, the low, the high, the high. We're basically seeing the highs and the low already, which is the first thing we want to identify: the highs and the low. Now, the second thing is referred to as break of structure. The break of structure is what gives us the impression that price is going to continue to go to the higher, to give us a new high. That means when price print a new high, price has given us a break of structure. What it tells us is that this point is a break of structure, break of structure, break of structure, and break of structure. The moment price print a new high in an uptrend, it simply refers to as a break of structure. Don't mind me, a break of structure. Now, it helps us to understand that price is going to continue to the uptrend if price is going to the uptrend, or if price is going downtrend. It helps us to understand that price is going to continue going to the downtrend. Now, what about change of character? Change of character simply tells us that price that is going to the upside is about to reverse to the downside, and this occurs when price fails to give us a new break of structure, but instead price gave us a new low. And it is confirmed when price take out the previous swing low, right? Remember, price was creating new low, was creating new highs, new highs, new highs, new highs. But change of character occurs when price give us a new low, which is not here. Which is not here. This was a low, 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 and price was meant to give us a new high, but instead price gave us a new low. And this is what we want to use to confirm if price that is in the key level is going to continue going to the upside, or is going to retrace to the downside, or is going to change to the downside. Now, when price prints a change of character, it gives us this impression, or give us this signal that price that is going to the upside is about to start going to the downside. And this is how you identify a market structure, by simply being able to identify the highs and the low, the highs and the low, the break of structure, and the change of character. Now, when price gives us a change of character, and we want to identify this on the 4 hours time frame, and when price gives us a change of character, the next thing we want to know is to understand where a crease zone is price going to come back to continue in lower low, lower low, lower low. Do you understand? So basically, once price prints a change of character, is a signal that price that is going to the upside is likely going to start going to the downside in this case scenario. Now that is the second step, identifying market structure. What about the third step, which is identifying liquidity? For us to identify liquidity, we want to be able to understand supply and demand zone at this point here. That means the point where price gave us a change of character, or the last high that price printed and the last low that caused the change of character. We want to identify a supply or a demand zone at that point, depending on the trend of the market. Now, in this case scenario, price is about to go to the downside. That means we're actually going to be identifying a supply zone at this point. At this point. Just look at how we're going step by step. First, identifying key levels. Second, identifying market structure. And now, identifying liquidity. And I'm saying to you, for you to be able to identify liquidity, you want to simply understand this point where price gave us a change of character. Because when price gives a change of character, it's come back to a supply zone to continue the downtrend if it's in the scenario of a downtrend in this example. And that's basically about there are two types of supply zones: rally based drop and drop based drop. We want to identify if price give us any of those things in this point here. for us to be able to identify a liquidity. Now, remember, this whole thing was explaining now is going to happen. It's happening on the 4 hours time frame. Now, having identified a price give us a change of character, and we identified a supply zone. I didn't go in details how to identify a zone or supply zones in this demand or supply zone in this particular phase, because I've explained it all over and all over again in my previous video. But let's, for instance, we're able to identify a supply zone at that level here: a drop, a base, and a drop. Remember, this was the high and this was the low that caused a change of character at this point here, right? Now, for us to know where we're going to sell from, because price have changed character to continue the downtrend, we want to simply identify this supply and demand zone here, which we have identified at this point here. Now, having identified it, we want to simply refine it to become a point of interest. And once you refine it to become a point of interest, you're simply using a specific candlestick. I know you're not a newbie, but if you're a newbie, you have to go and learn how to understand all those chart patterns: dodgy candlestick, shooting bar, pins, all of those stuff. So you have to be able to understand how to identify them, because we're going to be using it right here to refine our point of interest. And once we refine it, it becomes like this. And now the reason for refining a supply zone is to reduce the amount of drawdown you're going to have, or to reduce the size of your stop loss. If you're not able to refine your supply zone or demand zone, you're going to have a very wide stop loss, or you're going to have a very large drawdown, which you don't want to have. Now, having refining these zones to become a point of interest, we want to understand liquidity and how price can induce liquidity at this point, to know if this point of interest is going to hold or is not going to hold. Remember, a point of interest is likely going to hold when there's liquidity that is going to be able to trigger that point of interest. If there's no liquidity to trigger that point of interest, it's not going to hold. So once there's liquidity to trigger the point of interest, then it will hold. And how do we understand, or how do we identify liquidity? There are basically about 2 types of liquidity: the equal highs and equal low, and trend line liquidity. That means for this point to hold, we want to simply see price give us a trend line to this point, give us an equal high, sweep the liquidity, and then begin to go to the downside. That's when we can say that this point is going to hold. Without liquidity, price is not going to move. If there's no liquidity at this point, price is going to use this point to become a liquidity for the sell to continue. Now, how do we identify liquidity? That's a very, very, very complex topic that I'm going to be treating in my next video. I don't want to go into detail how to identify liquidity in this particular video, because it's going to be very boring and it's going to be very long. So in my next video, I'm going to especially talk about how to identify liquidity in details. That'll be all for this video. I'm going to see you in the next one. Peace.